Let's move on to a bond that's sold for a premium. Remember that anytime the market rate is less than the coupon rate, or the rate that we're paying the interest on, it's going to sell at a premium, meaning a higher price than its face value. So on January 1st, 2010, we have a $500,000 8% bond that's sold at 101. It's 10 years to maturity, and the interest is paid on a semi-annual basis. So we've started our entry for the issuance of the bond. We're going to debit cash because we're receiving cash, and we've sold it at 101. So 500,000 times 1.01, or 101%, is going to give us $505,000 that we received. Okay? The premium on that bond, remember, we're always going to list bonds payable at its face value. So we're going to credit that for the $500,000, which is this right up here. So the premium is going to be the difference between the two. 505 minus 500 gives us 5,000. That premium is going to be amortized over the life of the loan or the bond, and so it's going to be 20 periods. 10 periods broken down into semi-annual payments, which is 2 times a year, or 20 periods. So we've got 5,000 into 20 periods, and that's going to give us $250 every 6 months. Okay? So we are going to debit our interest expense. We're going to debit the premium on bonds payable. Remember, whenever we credit it up here, we're going to have to debit it in order to lower it. Okay? The idea is at the end of the loan, this $5,000 in the premium on bonds payable account is going to be zeroed out. So we started out with a credit. Every 6 months, we're going to debit that account for that $250 in order to zero it out. And we don't know what our interest expense is going to be yet, but our premium on the bonds payable is $250. The cash amount is what our interest payments are going to be. If you remember, we're going to pay the face value. In order to calculate the interest payment, we're going to pay the face value times the coupon rate. So 500,000 times the 8% divided by 2, or 500,000 times 4%, which is half of the annual interest rate, is going to give us $20,000. That's going to be my credit because I'm paying this out to the investors. And then our interest expense is simply going to be a plug figure. Our credit minus our debit is going to give us $19,750.